All right, so the Reserve Bank of India-led Monetary Policy Committee on Wednesday retained repo rate, the key lending rate, at 6.5%, announced Governor Shaktikanta Das. The MPC also decided unanimously to change the withdrawal of accommodation stance to neutral, to remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. Now, consequently, the rate-setting panel also kept a standing deposit facility, that is SDF rate, unchanged at 6.25%, and the marginal standing facility, which is MSF rate, and the bank rates at 6.75%. Now, RBI's shift to the neutral stance reflects that it is willing to increase the money supply to support the economic activities. Also, TAS's message to NBFCs: banks and NBFCs on their part need to carefully assess their exposures. Now, considering all of this, what's in store for you as an investor, as a borrower? Let's decipher and decode. I have with me Adil Shetty, CEO, co-founder, bankbazaar.com; Gautam Kalia, Senior Vice President and Head Super Investor at Sharekhan by BNP Paribas. Good evening and welcome to the Money Show. And Adil, I'll begin with you because we really need to understand the kind of change in stance from withdrawal of accommodation to neutral. What does this mean? And although it wasn't surprising, the street and everyone else was really expecting no rate cut initiating from this particular announcement. But having said that, what's the sense are you getting in terms of the rate cut scenario beginning in the country? Because inflation still is slightly a concern, and also we were very optimistic after the US rate cut, but sudden geopolitical tensions and overall change in global market and economy scenario might have also led to this particular pause and just a change in stance. But how do you look at it? And going ahead, what's the sense of rate cut beginning in the country you're getting, Adil?
Right. So, Kavita, what this means is that there was a small probability that people who have a home loan would have seen some benefit today because the repo rate was cut. I think that small probability did not happen. So we'll have to wait for longer for the repo rate cut to happen. This also means that if you're a fixed deposit saver, we are at the peak of the fixed deposit rates. If you're going to sign up for a 1 or 2 year FD, this is a good time to do it, right? And I think the important thing that you rightly pointed out is the stance is changed to neutral. Now, typically, right, and obviously I don't have a crystal ball, but typically the change of stance moving to neutral is a sign that we're entering a lowering repo rate cycle. Now, will this happen by March? I think certainly home loan borrowers will hope so, but we'll have to wait and see. But given that for the very first time, the stance has been changed to neutral, given that the growth prospects for Indian GDP remain good, we're expecting 7.2% GDP growth this year, given that inflation is trending to 4.5% for this year. I think we all hope and we expect, right, that starting December, hopefully, we'll start to see the repo rate consistently go down multiple times in 2025, and thereby our home loan EMI will automatically go down for people who have a repo home loan.
Exactly. The only dampener is it being the festival season, and people were really expecting that kind of a relief or a good news from RBI in this announcement. But then having said that, it's still an opportunity to park in money in fixed income instruments. So, Gautam, what are the options? And yes, lock in money in higher rates in fixed deposit. Maybe look at a few categories of debt mutual fund. And can we also look at a long-term duration fund? Is that a strategy that you might want to recommend, Gautam?
Yes, so for the last 6 months to 1 year, we have been telling clients to add duration in their portfolios because we've been anticipating a pivot. And obviously, the Fed has already pivoted, and we were hoping that the pivot would start happening now. But now, with the commentary today, it's clear that the expectation is probably Q4 of the end of the financial year. So basically, Jan to March quarter is what we're looking at announcing, especially with the hope that inflation will come down after the winter crop is available. So hopefully food inflation will help come bring the overall inflation numbers down. And anyway, the inflation number is very close to the target number. So mostly for clients, we've been telling them to add duration. I think they can stay on with slightly longer duration, but short duration has always been a very good space to be in, especially because of many clients with the perspective of comparing short duration to fixed deposits, and they are not really looking at debt for that 0.5%, 1% more. For the clients, obviously, who are looking to maximize their debt returns, then adding duration would make sense, especially with this announcement, because rate cuts seem to be delayed for a bit.
Adil, one very important word of caution, for HFCs and NBFCs that Governor Das also mentioned, them focusing more on the growth aspect of it. How would you like to help our viewers understand this? Because, this is a particular season where personal loan is going to be the number one kind of loan. Not that it's not been for a very long time. We are already there. But then, how would you like to decode the word of caution coming up from Governor Das?
Yeah, so basically, what I'd say is that if you're looking for a loan as an individual and looking to take leverage right now to buy something, I would say keep in mind, assume that the rate is not going to go down for the next 1 year, and keep that in mind in your calculation. I think that's a conservative way to approach it, and that's what I'll say, because there is no guarantee of a pivot. Clearly they've kept their options open, and they can very well change their stance if they want to maintain their stance, maintain status quo. So that's why it's better to keep that thing in mind, especially because of the geopolitical tensions. We've seen historically what happens is that we end up importing inflation, especially when oil prices go up, and the countries in question are obviously major oil suppliers. So we need to keep that in mind before we really go ahead and build upon leverage.
Sure. Adil, your take on this?
So, Kavita, I think I agree with the Reserve Bank governor's suggestion. In fact, the Reserve Bank said this also in October of last year when the risk weight averages were increased for unsecured credit. I think let's just decode what the governor is saying. So, what the governor is saying is be prudent and do not over leverage. I repeat, right? The message is very clear: be prudent and do not over leverage. So, if you can afford that loan, if you can afford that spending on your credit card, by all means, enjoy the festive season. There are a number of no-cost EMIs. There are fabulous, fabulous offers that are currently running on various e-commerce platforms, and you should use that to get a good deal. But do not take many of these small ticket loans and find yourself in a position, right, where you're not able to pay it back. Now, this is good advice both for a consumer, saying it can send your credit score down. Today, your credit score can go down for a small 10,000 rupee personal loan, but tomorrow you might not get a home loan because of that. You might not get a business loan because your credit score is low. And it's also good advice for the lenders, right? Saying that just grow in the right speed, right? So maybe the right speed is 21%, maybe the 30% is excessive. So I think it's just the right same message that has been coming for the last 1 year, saying grow, but grow prudently such that you do not increase your non-performing asset level, because that's not good for anyone. It's not good for consumer because your credit score will plummet, and it's not good for the lender, right? Because your return on asset will deteriorate.
All right. So quick takeaways in terms of portfolio planning. Let's just talk about rebalancing or revamping your portfolio, at least keeping your portfolio ready for a rate cut scenario. Gautam, I'll go with you first. What's going to be that recipe or that particular change that one should be ready for in terms of their financial planning or the entire financial portfolio we talk about?
Great. So if you already have a portfolio where you've done your asset allocation, keep in mind that rate cuts have been delayed. They are imminent. They're probably expected next year. At worst, I would say middle of next year. So if rate cuts are coming, then obviously your debt portfolio is going to do well. Add up on duration. So within the debt, if you're comfortable taking more aggression, do that. You have to keep in mind of on the equity side on interest rates sensitive sectors. So make sure that you're not overloaded on thematic plays on interest rate sensitive sectors in advance, but you can increase your exposure there gradually. But that is obviously a part of your portfolio. Make sure that your core portfolio remains diversified funds, especially on the equity side.
Adil, what's going to be your take on this or your recommendation?
Sure, Kavita. So, see, two pieces of advice we're giving people on Bank Bazaar. So, the first is if you're a FD saver, and a lot of people, right, especially senior citizens, tend to be FD savers, this is a good time to lock in your FD for the next 1 to 2 years because this is probably the highest FD rate you're going to get. Now, if you're a younger person, right, what we recommend is on the debt side, I think it was well covered. But on the equity side, India continues to remain a long-term bright spot. The GDP this year has reiterated that it'll grow at 7.2%, which is the fastest growing large economy in the world. So we would say if you have the patience, you can hold on for 5 years. You're saving for a daughter's education or you're saving for a house you want to buy. Think about an index fund and just fill it and forget it, right? And just wait for 5 years. Obviously, things might go up and down in the short term, but in the long run, right, nothing can beat equity, and the index fund gives you a fantastic product in India where without thinking, right, you can get the benefit of the Sensex or the Nifty.
All right, I think that will be all. Thank you so much, Adil, for being on the show and helping our viewers understand every bit of information from the RBI's policy today. Thank you. All right, let's take a quick break, and post that we'll be joined by our viewers and we'll be doing their life financial planning. Gautam Kalia is connected and he'll be answering your portfolio queries live. But just in case you want to send across your questions, you can do that on our WhatsApp number and email ID. See you after this break.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.